A tulip for the price of a mansion. A company valued at billions of dollars just because it has .com at the end of its name, or a JPEG of a monkey valued at $1.3 million, all completely worthless within months. For centuries, markets have followed the same pattern before disaster strikes. The Dutch saw it in 1637, Wall Street saw it in 1929, and the world saw it in 2008. And right now, these exact same warning signs are flashing. In fact, they're almost always flashing with some sort of asset in the market. But here's what everyone misses. The signs of a bubble are always hiding in plain sight. And in this video, I'm going to show you what history's biggest market crashes have in common, and why these patterns matter more than ever today. But before I get into it, my name's Nolan Matthias, and if you want the truth about finances, the real truth, no BS, and you believe that there's always opportunity in crisis, then this is the place for you. So do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. Okay, so let's get into it. It's clear that bubbles are always happening. At any given time, at least as long as I've been alive, and probably as long as you've been alive as well, there's always been some form of asset bubble forming. But it's usually far too late before we even realize that it's happening. But the question is, why do these bubbles form, and why do we always miss them, when in hindsight, they seem so obvious? And a better question is, what things are happening right now that are likely bubbles that we need to be paying attention to before we dump every single penny we have into those assets? And in order to understand this, we need to understand the historical patterns that always lead to a bubble. They've been the same throughout history, whether it was tulips in Holland, 1929, or the major financial crisis of 2008. And the question is, why do bubbles keep happening throughout history? Well, the answer is really simple. Economic cycles tend to recur over and over and over again, with different assets replacing the ones before it. And the human psychology that we have yet to shake is our biggest downfall when it comes to investing. And that psychology most often is driven by greed and a belief that this time is different. I mean, just think about it. During the .com bubble, how many times did you say it's different this time? And during the run-up in housing prices leading up to 2008, how many times did you hear people say, whether it was on the news or in person, that housing prices can't go down in value because everybody needs a place to live? Or when everyone's been buying Bitcoin and they seem so certain that the US dollar is almost certainly going to crash and that the decentralization of currencies is almost completely a certainty. But the reality is this time is almost never different. Even though it may seem like it's going to be different leading up to the inevitable crash, it almost never is. But it's not only the belief that this time is different, it's also the belief that there's going to be a new paradigm. And this is a new paradigm every single time an asset seems like it is going to go to the moon. There's always that psychological allure of new trends, like electric cars and Tesla, which, by the way, I'm still not entirely sure that it makes sense to burn coal and natural gas in order to fuel our electric vehicles. How is that any better than the gas that is currently being used? Or then there was the Dutch tulip mania, which is completely insane in its own right when you think about the fact that tulips were so valuable just because they had some weird color profile and they represented wealth. Clearly, a flower that anybody can grow is not something that is going to sustainably be valuable. And then there, of course, was the .com bubble bust and the crypto boom. Don't even get me started on all the .com companies that were valued at billions and billions of dollars with no real logical sense. In fact, to this day, the only one that really survived was Amazon.com. And it seems that the reason why it was the one that survived was because it was actually the one that actually had a real business model and wasn't just built on hype. And that hype, the lack of a business model and the hype associated with different types of investments is a key indicator in why bubbles form and eventually crash. And here's the thing, a bubble bursting is almost always predictable if you're looking for the right things. And sometimes looking for the right things simply means not investing in something that seems like it is crazy, even though there is the chance that it may not in fact be a bubble and you could make an insane amount of money from it. And the 5 stages of every bubble forming are displacement, a new innovation or paradigm shift. The shift from fiat currencies to independent currencies like Bitcoin, for example. That's a new innovation. It's a paradigm shift. But the thing that would make it sustainable, which is the actual crash of the US dollar and fiat currency around the world, is something that is a risk, yes, but everybody who is investing in Bitcoin and other cryptocurrencies right now is acting as if it is a certainty. And the reality is, it's not. Could it happen? Yes, but putting every single dollar that you have into cryptocurrency because of something that might happen is a fool's errand. Now, that's not to say that you shouldn't be putting a little bit of money into it, but the people who are borrowing or putting every penny that they have into it are taking a major risk. Then you've got the boom cycle. Prices start to rise slowly. Think about housing prices in 2001 that slowly started to rise and really ramped up in 2005, 2006, and 2007. They gained a lot of momentum, and that momentum led to euphoria. FOMO kicks in, the greater fool theory dominates, and everybody has to not only own a home, but own multiple homes. And when you start hearing things like taxi drivers own entire cul-de-sacs of homes in Texas, well, that's usually a pretty good indicator that things have gotten out of control. Now, the one thing that most amateur investors don't see is that when the smart money quietly exits, they start taking their profits. And we've seen this in things like GameStop. We've seen this in things like Bitcoin. We've seen this in things like the dot-com bubble, where the smart money takes a significant amount of their profits off the table in order to lock in the gains. Because the smart money realizes that diversification is all about diversifying risk. And when too much of their portfolios gets invested in any single asset, they pull money out of that asset, not because they are necessarily thinking that the investment isn't a good investment anymore, but they see that their risk profile has exceeded what they want it to be, which is when they start to pull the money back. And this inevitably leads to panic, because eventually, when people notice that the smart money is leaving, it leads to mass selling of all the rest of the investors, and that leads to the price collapses. And this happens all the time throughout history. I mean, just take a look at this chart of different asset bubbles over the last 45 years. You see gold in 1977 to 1981, and yes, indeed, gold can be in a bubble. In fact, it may very well be in a bubble right now. Even though it is deemed to be something that is an investment that only goes up in value and is very safe, the reality is it isn't. And in many cases, it has lost a significant amount of its value in a very, very short period of time. This hasn't just happened once in history or twice, it's happened many times in history. Then you've got the tech bubble in 2001. You've got US home values in 2006, 2007. You've got the oil bust. You've got Bitcoin in 2017, 2018. And we very well could have a new tech bubble in 2024, 2025. But here's the thing. It's hard to determine when it is a real asset bubble and when it is actually a bubble that's sustainable. And in the absence of being able to have a perfect crystal ball, I'll talk about how to protect yourself a little bit later on. But before we talk about that, you need to understand that it's the same story every single time. There's similar patterns, similar warning signs, and quite often they are ignored. So when it comes to investing, there are questions that you should probably ask yourself before you make an investment in anything. The first is, are the increases in the value driven by irrational exuberance? Now, this was a term that was coined by Federal Reserve Chairman Alan Greenspan. And what irrational exuberance refers to is the excitement around an asset class that just seems to be abnormal. And the second question is, are the rise up in these values sustainable? Because quite often, if you just ask yourself these two questions, it can become clear if something is in fact in a bubble. And not only that, it can become clear long before the bubble ever bursts. So let's talk about how to recognize bubble peaks. The first thing you need to look for is widespread speculative activity. There's a difference between investing and speculating. Investing is a long-term strategy where you're looking for things that are undervalued that will continually go up in value. Speculation is when you are investing in something or betting on something that you hope will go up in value quickly and make you rich. And when people start looking at an investment as a speculative investment, one that they think that they're going to shoot the moon on, that's usually a good sign that we're in a bubble. And then on top of that, when it starts getting to the point where there's media coverage around an asset, and it seems to be getting to the extreme, and things are being said like, could anything stop real estate? Can anything stop Bitcoin? Can anything stop tech companies? That's usually a pretty good sign as well that we're heading towards the top. But here's the big thing. When normal people, average people, start making very risky investments in an asset class, that's the time where usually you need to pump the brakes, especially in times where people are not only making those risky investments, putting their life savings into an asset, but also doing it with leverage, borrowing money in order to put more money in because they hope that it's going to be their one shot and done, and because they have the irrational belief that there's no risk involved. And let me tell you this, anytime you borrow money to make an investment, there's not only risk involved, but you're increasing your risk exponentially. So here's the things that you need to look for when it comes to identifying bubbles. The first is the everyone's getting rich effect. So if taxi drivers start giving stock tips like they did in 1929, or Uber drivers like they did in 2017 with respect to Bitcoin, or the pizza delivery guy is flipping houses in 2008, or teenagers are becoming crypto millionaires in 2021, investing in things like Dogecoin, which is absolutely absurd, that's usually a pretty good sign that a bubble is about to pop. Anytime that everyone is talking about something like it cannot go down in value, that's when you start needing to head for the exit. Then when there's dangerous financial innovation, things like margin trading in 1929, collateralized debt obligations in 2008, which by the way, nobody really knew about these until after the financial crisis, or NFT-backed loans. So in other words, lending against the value of things like JPEGs of monkeys, for example. Or you start seeing complex financial instruments making speculation easier. These dangerous financial innovations are a sign that things are going to get exponentially worse really quickly. Then there's my favorite. It's the change in media coverage, the transformation in how the story is told. Take, for example, cryptocurrency. Phase 1, skepticism. You had every major politician out there going, Bitcoin is fake, it's not real. And well, yes, it very much did become real. Then you started seeing curiosity. Could Bitcoin actually be this thing that takes over from the US dollar? Then you started seeing enthusiasm. Bitcoin goes to the moon. Then euphoria. Bitcoin can't be stopped. And then phase 5, which is the to the moon. Another new record hit, another new record hit, another new record hit. But all the while this media coverage is happening, there is some significant signs that the value of these investments can't continue to go up forever. And this is the mathematics of impossibility. Take, for example, the 1990s. The real estate of Japan was valued significantly higher than all of the real estate in the US. Or in the year 2000, when dot-com companies were worth more than traditional industries. So you had a company that literally had no assets and no products being worth more than a company like Ford or GM. Or in 2021, when the total market cap of Dogecoin was worth more than many Fortune 500 companies, which was absolutely ridiculous. I mean, think about it. This was literally a cryptocurrency that was a joke. It was a dog cryptocurrency that somebody made as a joke that became worth more than Fortune 500 companies. Talk about irrational exuberance. And this is where the modern bubble indicators come into play. Anytime there's high leverage ratios, so in other words, people are borrowing to buy, there's a disconnect between prices and fundamentals or even reality, or there's risky financial behaviors, those are bubble indicators. The second you hear about somebody investing everything they own in a hyped up stock, that is the time to get out and run for the doors as fast as humanly possible. Now, even though in hindsight it's always obvious when a bubble occurs, it's not always completely obvious while it's happening. So let's talk about how to protect yourself from a bubble. So the first thing you need to do is be cautious when everyone else is optimistic. If everyone is talking about something and there's seemingly complete and unanimous certainty around the value of that investment, it's probably a sign that things are about to turn. And most importantly, you need to start looking at every single investment and try to determine whether it is overvalued relative to pretty much everything else. Take, for example, Tesla, which for a long time was valued at significantly higher than many other car companies, even though their revenues were nowhere close. So recognizing when something is clearly overvalued is one of the keys to making sure that you can get out of it before it comes back to its inherent value. And then you want to make sure that you're diversifying your investments. And again, diversifying investments isn't about owning a whole bunch of different stuff. It's about diversifying your risk so you're not overexposed to anything that may be overvalued. Because even if you can't recognize that something is overvalued, if you are diversified and an overvalued investment goes in the tank, well, the rest of your investments, at least hopefully, will help you ride out the storm. So let's talk about diversification. So diversification is all about risk mitigation. You need to spread your investments across assets and avoid putting all of your eggs in one basket. So in other words, let's say you do invest in one of these things that has a bubble forming. Now, it's one thing to let your winners ride, but it's another thing to let the entirety of your net worth be exposed to one individual asset or asset class. So what you need to do, even though it may seem hard at times, is start taking profits from those things that start to dominate your portfolio. There should never be one stock or one asset class that holds up a significant portion of your net worth. So, for example, let's say you had invested in Bitcoin in 2014 and it ran to the moon in 2017, and now you found that you had a significantly higher net worth, but almost all of it was in Bitcoin. That would have been a very good sign that you should be selling a pretty significant portion of your Bitcoin holdings in order to invest in other things that weren't A, as risky, and B, minimized your exposure in the event that Bitcoin, like it did, went down in value. So let's say you had invested, I don't know, $10,000 in Bitcoin and it became worth $3 or $4 million. Wouldn't it have made sense to take $3 of that $4 million off the table, invest it in other things that were completely uncorrelated from Bitcoin so that you wouldn't find yourself in a situation where your money disappeared pretty much overnight? I think the obvious answer is yes. And the same goes for things like gold, because right now many people have been investing all of their money into gold, thinking, hey, central banks and other countries are buying up all the gold, it's going up in value, and it's one of those assets that can never go down. So I'm just going to keep all of my money in there, thinking that it can't implode. And as we saw in the 1980s, it absolutely can. So if you've had a big run up in the value of your gold holdings, yes, it absolutely makes sense to take a little bit of the profit and make sure that you're not overexposed to that one asset. And the same is true for stocks, the S&P 500, bonds, and everything else. You should be using something like the all-weather portfolio, where you are diversified so that when one asset class finds itself in trouble, the other ones keep you afloat during the times when you're losing value in the other things. And this is where it gets really difficult, because the hardest thing to do is to decide whether or not you should let your winners ride or whether or not you should take profits. And it's my belief that you should absolutely let your winners ride, but only to the extent where they don't dominate your portfolio. And when you do have an investment that has done very, very well, I'm also a believer that unless it is very clear that it's going to go to zero, you shouldn't necessarily take all of your money out of it. You should just take enough out to mitigate your risk. But more importantly, it's also important that you avoid taking on any debt in order to invest in risky assets, and you need to focus on long-term stability when it comes to your investments. It isn't about finding that one thing that shoots to the moon. It's about doing the same thing for a long period of time and making sure that your risk is mitigated. Because money is one of those weird things. You can with certainty become rich if you just take a little bit off the top and invest it every single month for your entire lifetime. But if you're taking big risks on any sort of investment that is deemed to be one of those investments that can only go up in value, well, the chances of you hitting a home run is probably pretty slim. But if you constantly are hitting base hits and you hit enough of them, you can definitely build wealth over time with complete certainty. That's why there are janitors and people who work at McDonald's for 20 or 30 or 40 years who end up being millionaires. It's because small little investments over time create complete certainty in the fact that you're going to build wealth. But trying to hit home runs has a similar level of certainty, but it's more likely to the opposite effect that you're going to go broke. And this is where it gets important to have recognition tools at your disposal. Using fundamental analysis, looking at stocks and going, does this seem to be too good to be true? Looking at price to rent ratios and noticing that it is way more expensive to own a home than it is to rent is usually an indication that a housing market is overvalued. And understanding basic risk assessment frameworks. If I have all of my money in this one thing, is it going to put my portfolio at risk, and am I going to end up broke as a result? Maybe the answer is yes, maybe the answer is no, but it's pretty simple to diversify in order to make sure that the answer is with certainty no. And when it comes to investing in stocks, for example, it's pretty simple to analyze company financials. You want to look for stable earnings. You want to avoid hype-driven stocks. You want to make sure that the price to earnings ratios are in line with where they should be for the industry, and make sure that there just isn't anything funny going on with the company. And one of the easiest things you can do is take a look at a stock, compare it to what's going on in other stocks that are similar, and see if things make sense. For example, as of this filming, there is a real estate company that is significantly smaller than Remax, but it has a valuation that is significantly higher than the biggest real estate company in the world. So if that's the case, it becomes pretty clear that it is a hype-driven stock, not a fundamentals-driven stock, which means that you should be able to avoid what is pretty clearly a bubble in that stock. But here's the most important part. It all comes down to prudent investing, avoiding the herd mentality, focusing on fundamentals, and remembering long-term goals. And there's two things that one of my mentors once told me that have kept me from losing big amounts of money on any one thing, primarily because over my entire investing career, I've never invested a significant portion of my money in any one thing. Those two things are this: be fearful when others are greedy. And by the way, this is a Warren Buffett quote, and greedy when others are fearful. So in other words, when things are going down in value, that's often a really good time to buy. But on the way up, it can quite often be the beginning of the end. And never invest in anything you do not thoroughly understand. And what he meant by this is if you don't understand the fundamentals of what you're investing in, it's probably a bad idea to invest in it. And at the end of the day, it is your responsibility to understand the things that you invest your money in. Not your stockbrokers, not your financial advisors. You need to understand where your money is going, whether it's the right investment for you, and whether your risk tolerance supports you making that investment. And unfortunately, this isn't like a video game where we get the rules and we get the instructions at the beginning and we know how to play and what the objectives are, because school just simply doesn't teach us that. We have to learn for ourselves what our objectives are, and then we need to do whatever it takes to learn the things we need to learn in order to meet those objectives. The responsibility completely lies with us. And the key thing is to make sure that you don't find yourself overexposed in the middle of a crisis. Oh, and by the way, if you want to see a video on what always happens before a financial crisis, make sure you check out this video right here.